Did you know that 50% of the U.S. stock market wealth creation has come from 0.33% of the listed companies since 1926? That's what makes stock picking so difficult and unsuccessful. One easy way to track the U.S. stock market is by investing in the S&P 500, which is commonly known as the market. Three of the most popular S&P 500 ETFs out there are Vanguard's S&P 500 ETF, BlackRock's iShares Core S&P 500 ETF, and State Street's SPDR S&P 500 ETF. But what are the differences between these three, and which one should you go for? That's what we will look at in this video. Let's go. Welcome to Wealth Echelon, your go-to channel for all things finance, investing, and wealth-building strategies. Our mission is to simplify complex financial concepts, helping you make informed investment decisions. If you're looking to grow your wealth and expand your financial knowledge, you're in the right place. Right, before we start, if you're not sure what an ETF is or how it works, then check out the video in the link where I explain the concept in a super simple way. Fund provider. Let's start by looking at the most obvious difference between the three ETFs in this video. The fund providers. VOO is managed by Vanguard, IVV by BlackRock, and SPY by State Street. If we look at the largest fund providers globally by assets under management, you will see these three ETF providers at the very top. They are also called the Big Three in the ETF world. All of them have assets under management of over $800 billion. There is a big gap between these and the next largest ETF provider, Invesco. Among these three, BlackRock and Vanguard manage twice as much money as State Street. If we look at the number of ETFs, BlackRock has a clear advantage over Vanguard and State Street, with almost 400 ETFs, 3 times more than State Street and 5 times more than Vanguard. Looking at the estimated revenues from their ETF businesses, BlackRock is the clear number one with estimated revenues of over $3 billion, more than 3 times as much as State Street and Vanguard. This is due to each fund's expense ratio, which we will get to in a moment. Vanguard is known for having the cheapest ETFs, which also means they don't earn as much money as BlackRock, whose average expense ratio is more than 3 times higher than Vanguard's. To sum it up, BlackRock manages the most funds, has by far the highest number of ETFs, and the highest estimated ETF revenues. That's why BlackRock's IVV comes in at number 1. Vanguard has the second highest funds, a lower number of ETFs, but they are carefully selected with the lowest average expense ratio. That's why Vanguard's VOO gets ranked second. Lastly, State Street has significantly fewer assets under management, but still a high number of ETFs. That's why State Street's SPY comes in at number 3. That means 3 points for IVV, 2 points for VOO, 1 point for SPY. Investment goal. All three ETFs track the S&P 500, which is the most widely used index globally. This index tracks the 500 largest companies in the U.S. To be included in the S&P 500, a company needs to meet some requirements. It has to be a U.S. company. It must meet the market cap requirements and be one of the largest U.S. stocks. The company must have a public float of at least 10%, meaning at least 10% of its shares are available to the public. Its most recent quarter's earnings and the sum of its trailing 4 quarters' earnings must be positive. This earnings criterion was why it took Tesla so long to be included in the S&P 500. All three ETFs invest in 503 companies instead of 500 because the S&P 500 includes 3 companies with 2 share classes, Alphabet, FOX, and News Corporation. These 500 companies provide great diversification, covering about 80% of the total U.S. stock market. The SPY is an absolute institution. It was set up in 1993, making it the oldest ETF out there. The IVV was set up in 2000 and the VOO in 2010. Regardless of that, they all have the same investment goal. That's why they all get 3 points. Costs. ETF costs are displayed as an expense ratio, which represents the operating costs of running a fund. Both the VOO and IVV have an expense ratio of 0.03%, one of the lowest for ETFs. If you invest $1,000 in an ETF with an expense ratio of 0.03%, your ETF cost will be 30 cents per year. The SPY, on the other hand, has an expense ratio of 0.09%. This is due to the SPY being set up in the 90s as a unit investment trust, UIT, which has different regulations than modern ETFs. A UIT must keep all shares it buys in-house, while an ETF can lend its shares to other firms and earn interest. A UIT also has to hold all dividend payments in cash rather than investing them in short-term bonds. These factors explain why the SPY has a higher expense ratio. So in terms of costs, VOO and IVV share position number 1 and get 3 points each. SPY comes in at number 3 and gets 1 point. Fund size. A large fund size is important for ETFs because it shows liquidity. If an ETF has a small fund size, it is less liquid and fewer people are trading it. The fund sizes are VOO, $264 billion, IVV, $298 billion, SPY, $365 billion. These 3 ETFs are the largest and most liquid ETFs globally. Ranking them by fund size, VOO gets 1 point, IVV gets 2 points, SPY gets 3 points. Performance plus tracking difference. How have these ETFs performed against each other? If we look at their performance chart since 2011, we can see that their annual returns are almost identical, as they all track the same index, the S&P 500. However, there are some small but notable differences. SPY lags behind VOO and IVV by around 0.05% annually, primarily due to its higher expense ratio of 0.09%, compared to 0.03% for the other two. While this may seem like a negligible difference, over a long investment horizon, even small variances in expense ratios can compound and impact total returns. The slight difference between VOO and IVV comes down to tracking differences. Tracking difference measures how much an ETF outperforms or underperforms its benchmark due to factors such as fees, management efficiency, and dividend reinvestment policies. In most cases, tracking differences are slightly negative because fund costs reduce returns. However, Vanguard's VOO and BlackRock's IVV have done an excellent job minimizing these deviations. Since all 3 funds closely follow the S&P 500, their differences remain minor, and all 3 ETFs receive equal points in this category. Which ETF is the winner? After analyzing performance, expenses, and tracking differences, BlackRock's IVV has a slight edge over the others due to its efficient structure and cost-effectiveness. However, the differences are minimal, meaning investors can choose any of these ETFs with confidence. SPY, despite its higher expense ratio, remains a highly liquid option with strong historical performance. Meanwhile, VOO and IVV offer nearly identical returns but at a lower cost, making them more attractive for long-term investors. Ultimately, the best ETF for you depends on your investment strategy, trading preferences, and portfolio goals. If you prioritize liquidity and trading volume, SPY might be the best choice. If lower expenses and long-term efficiency matter more, VOO or IVV could be better options. If you're interested in exploring international ETF options and real-world examples of simple ETF portfolios, be sure to check out the video linked below. What do you think? Did I miss any important points? Which ETF is your favorite? Let me know in the comments. I hope this video provided value to you. If you liked what you saw and want to support this channel, please make sure to subscribe. Thank you very much, and peace.